Investing for Beginners, your first steps to building wealth. Hey everyone, and welcome back to Wealth Unlocked. Today we're tackling a topic that many find intimidating, but it's absolutely essential for long-term financial success: investing. If the idea of stocks, bonds, and mutual funds makes your head spin, don't worry. This video is your beginner's guide. We're going to break down the fundamentals of investing, explain why it's so important, and give you actionable steps to start building your wealth, even if you're starting with very little. Get ready to transform your financial future. Why invest? The power of compounding. So why invest? The simplest answer is to make your money work for you. Inflation erodes the purchasing power of your savings over time. Keeping all your money in a savings account while safe means you're actually losing money in real terms. Investing allows your money to grow, often at a rate that outpaces inflation, helping you reach your financial goals faster. The most powerful concept in investing is compound interest. Albert Einstein famously called it the eighth wonder of the world. It's essentially earning returns on your initial investment and on the accumulated interest from previous periods. Imagine you invest $1,000 and earn 10% interest. In year 1, you earn $100. In year 2, you earn 10% on $100, which is $110. That extra $10 is the power of compounding. Over decades, this seemingly small difference can lead to exponential growth, turning modest investments into substantial wealth. The earlier you start, the more time compounding has to work its magic. Step 1. Define your financial goals. Before you put a single dollar into an investment, you need to know why you're investing. What are your financial goals? Are you saving for a down payment on a house in 5 years? Planning for retirement in 30 years? Saving for your child's education? Your goals will dictate your investment strategy, including how much risk you're willing to take and for how long you'll invest. Short-term goals, under 5 years, typically require lower-risk investments, while long-term goals can tolerate more volatility for potentially higher returns. Write down your goals. Make them specific, measurable, achievable, relevant, and time-bound. SMART goals. Step 2. Understand your risk. Tolerance investing always involves some level of risk. The higher the potential return, generally, the higher the risk. Understanding your personal risk tolerance is crucial. Are you comfortable with the idea of your investments fluctuating in value, knowing that over the long term they tend to grow? Or does the thought of seeing your portfolio drop by 10% make you lose sleep? Your risk tolerance is influenced by your personality, your financial situation, and your time horizon. A young person with decades until retirement can afford to take on more risk than someone nearing retirement, as they have more time to recover from market downturns. Be honest with yourself about your comfort level with risk. It is better to start conservatively and gradually increase your risk exposure as you become more comfortable and knowledgeable. Step 3. Choose your investment accounts. Once you know your goals and risk tolerance, it's time to choose the right investment accounts. For most beginners, tax-advantaged retirement accounts are the best place to start. These accounts offer significant tax benefits that can supercharge your growth. First, your employer-sponsored retirement plan, like a 401k in the U.S. or a similar plan in other countries. If your employer offers a match, contribute at least enough to get the full match. That's literally free money. These contributions are often pre-tax, reducing your taxable income now. Next, consider an individual retirement account. IRA. You can open an IRA independently. There are 2 main types. A traditional IRA, contributions may be tax-deductible, and growth is tax-deferred until retirement. And a Roth IRA, contributions are made with after-tax money, but qualified withdrawals in retirement are completely tax-free. The Roth IRA is particularly powerful for young investors who expect to be in a higher tax bracket in retirement. Finally, for money you want to invest beyond retirement accounts, a taxable brokerage account is your go-to. This offers flexibility as you can withdraw funds anytime, but you'll pay taxes on capital gains and dividends annually. Step 4. Select your investments. Now for the exciting part. What to actually invest in. For beginners, simplicity and diversification are key. You don't need to pick individual stocks to be a successful investor. In fact, for most people, it's better not to. Index funds and exchange-traded funds, ETFs, are your best friends. These are funds that hold a basket of many different stocks or bonds, designed to track a specific market index, like the S&P 500. When you invest in an S&P 500 index fund, you're essentially investing in the 500 largest U.S. companies, giving you instant diversification. They are low-cost, passively managed, and historically have provided excellent long-term returns. Mutual funds are similar but are typically actively managed, meaning a fund manager picks the investments, and can have higher fees. For beginners, stick to low-cost index funds or ETFs. You can buy these through your chosen brokerage account. Bonds are essentially loans you make to governments or corporations. They are generally less volatile than stocks and provide a fixed income stream, making them a good choice for diversification, especially as you get closer to retirement. Step 5. Automate and stay consistent. The secret to successful investing isn't timing the market, it's time in the market. Set up automatic investments from your bank account to your investment accounts on a regular basis, ideally every payday. This practice, known as dollar-cost averaging, means you invest a fixed amount regularly, regardless of market fluctuations. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this strategy can reduce your average cost per share and smooth out market volatility. Consistency is key. Don't panic during market downturns. History shows that markets recover and tend to grow over the long term. Avoid checking your portfolio daily. Focus on your long-term goals and stick to your plan. Investing is a marathon, not a sprint. Investing might seem complex, but by following these 5 fundamental steps, defining your goals, understanding your risk tolerance, choosing the right accounts, selecting diversified investments like index funds, and staying consistent, you're well on your way to building significant wealth. Remember, the best time to start investing was yesterday. The second best time is today. Don't let fear or procrastination hold you back from securing your financial future. What's your biggest takeaway from this video? What's one step you are going to take this week to start or improve your investing journey? Share your thoughts in the comments below. Your insights can inspire others. If you found this guide helpful, please give it a thumbs up, subscribe to Wealth Unlocked for more essential financial wisdom, and hit that notification bell so you don't miss our next video. Thanks for watching, and here's to your investing success.